You earned it. It hit your account. You can see the number. But here's the thing. That money stopped being fully yours the second it arrived. Not because of some conspiracy. Because of something far more structured, far more accepted, and far more total than most people ever stop to consider. Let's talk about what actually happens to your money after you earn it. When you get your paycheck, you think you're looking at your income. You're not. You're looking at what's left after the first cut has already been taken. If you're a salaried employee earning above a certain threshold, the tax comes out before the money even touches your account. It's called withholding. Your employer does it for you. Or rather, to you. You didn't make a decision. You didn't sign off on it that month. It just happened. Now, that might seem normal. Taxes fund schools, hospitals, roads. Fair enough. But here's the part that gets interesting. The government doesn't ask you how much of your income you want to contribute toward public services. It tells you, and if you earn more, it takes more. Not proportionally, progressively. Once your annual income crosses certain brackets, your tax rate climbs. At the higher end, you're losing nearly a third of what you earn, sometimes more, depending on your state or local taxes. That's the first entity with a claim on your money. The state, but you're cool with it. Or at least, you've accepted it because you still have something left. You still have control, or so it feels. Let's test that. You take what remains and decide to do something responsible. You park it in a bank, standard savings account. The bank says thanks, gives you maybe 0.5%, maybe 1% interest if you're lucky. Feels like you're being smart. Feels like your money is working for you, except it's not sitting there. It's gone. The moment your deposit clears, that money is no longer in the vault. The bank doesn't keep your cash in a box with your name on it. It takes your money and lends it to someone else, a business, someone buying a car, someone getting a mortgage, and it charges them 6%, 8%, sometimes 15% interest, depending on the product and their credit score. You gave the bank your money at 0.5%. They're renting it out at 8%. The difference, that's not your profit, that's theirs. You are not the customer. You are the supplier. The bank is the middleman, and the person who actually uses your money is paying the bank for access to it. You get crumbs, the bank gets the spread, and it's a fat one. Now, you might say, that's fine. That's how banking works. And you'd be right. It is how it works. But don't confuse how it works with who controls it. Let's go further. Say you decide to buy something, a car, a phone, a house. You take a loan. Now you're on the other side of the equation. And here's where the numbers start to do something wild. A house costs 300 grand. You take a 30-year mortgage at 5% interest. Your monthly payment is manageable. It feels structured, it feels like progress. But by the time you finish paying, you won't have paid 300,000. You'll have paid close to 570, almost double. You thought you bought a house for 300 grand. You didn't. You bought access to a house for 300 grand. And you paid 270 in interest for the privilege of not waiting. Now think about that for a second. Nearly half the money you pay goes to the institution that didn't build the house, doesn't own the land, and took no construction risk. It just moved money from one column to another. And for that service it gets almost as much as the builder did. This is the second claim. The financial system, and unlike taxes which are visible and debated, this one hides inside APRs and amortization schedules. It's in the fine print. It's normalized. It's expected. But it's still a claim. On your future income. On your time, on your freedom to choose what you do next. So now you've paid Uncle Sam, you've paid the bank, what's left is yours, right? Not quite. There's a third player, quiet, invisible, relentless. Every year your money loses value. Not because you spent it, because the currency itself is worth less. Over the past decade, inflation has averaged somewhere around 2 to 3% annually, with some years spiking higher. Let's say 3% to be realistic. That means if you saved 10 grand and did nothing with it, a year later it buys you what 9,000-7,100 would have bought before. You didn't lose the money, you lost the power. Now combine that with your 0.5% savings account. You're earning 0.5%, but prices are rising at 3%. You're not getting ahead, you're falling behind by 2.5% a year. Slowly, silently, automatically. This isn't theory, this is observable. Go back 10 years. Look at what rent cost, what gas cost, what groceries were. Now look at today. Your salary probably went up. But did it go up faster than everything else? For most people, hell no. So even the money you saved, the money you protected, the money you didn't spend, is being claimed, not by a person, not by a policy, by the structure of the economy itself. You are running on a treadmill that speeds up every year. And the dial isn't in your hand, but let's say you're smart. You don't just save, you invest. You buy stocks, you buy real estate, you diversify, you read the news, you follow the market, you try to beat inflation. And maybe you do. Maybe you get 8%, 12%, even 20% returns in a good year. It feels like winning. But here's the catch. Every time you make a gain, there's a tax on that too. Capital gains tax. If you sell a property or cash out stocks within a year, you're paying short-term capital gains at your regular income rate. Hold it longer than a year. You get the long-term rate, which is lower but still a cut. So even your wins are shared. Even your good decisions get taxed. The system is built to claim a percentage of everything you do. Earn it, taxed, save it, eroded, invest it, taxed again on the return. You might still come out ahead. But the idea that you have full control over the outcome is a joke. You're operating inside a framework where every move you make has a built-in cost. And you didn't design the framework. You were born into it. Now, this isn't to say the system is evil. It funds infrastructure. It stabilizes banks. It theoretically keeps inflation from spiraling into chaos. But it is to say this. The system has more claim over your money than you do. And it's not close. Let's zoom out. Think about the average person. They work for 30, maybe 40 years. They earn a salary. They pay taxes. They take loans. They save a little. They invest if they can. They retire. And by the end, if they're lucky, they have enough to live on. Maybe leave something behind, but add it all up. Add up the taxes, the interest, the inflation, the fees on transactions, on accounts, on transfers, the depreciation on things they bought, the maintenance, the insurance, the medical bills that weren't covered, the emergency expenses that weren't planned. Now subtract all of that from total lifetime earnings. What's left? For most people, it's a fraction. Maybe a third, maybe less. The rest went somewhere else. To governments, to banks, to markets, to the cost of living in an economy that consistently extracts more than it returns. And yet we call it your money. You earned it, yeah, but you never fully controlled it. Here's the uncomfortable part. This isn't a bug. It's the design. Governments need tax revenue to function. Banks need depositors to lend. Markets need participants to grow. Inflation keeps people spending instead of hoarding. Debt keeps people working instead of retiring early. Every part of the system has an incentive to keep you in motion, earning, spending, borrowing, saving just enough to stay stable, but not enough to exit. If you paid off your house tomorrow, the bank loses decades of interest. If you stopped taking loans, the credit system shrinks. If you pulled all your money out of the economy and stuffed it under a mattress, inflation punishes you. If you try to dodge taxes, the IRS punishes you. The game is rigged so that opting out costs more than playing along. And most people never see it this way, because it's sold as normal, as responsible, as the way things are. But the way things are is just another way of saying the way someone decided they should be, and that someone wasn't you. So who actually controls your money after you earn it? Not you, not fully. But government takes its share before you see the full amount. The bank takes its margin while you sleep. Inflation takes its cut while you wait. And the market takes its fee every time you move. You get what's left. And you're told to be smart with it. Maybe you are. Maybe you beat the average. Maybe you save more, invest better, dodge some of the traps. But even then, you're still playing a game where the house sets the rules, deals the cards, and takes a cut of every hand. You can win, but you can't change the table. The question isn't whether you control your money. The question is, how much of it was ever really yours to begin with?